So what do you know about bonds? Any idea? What is bonds? How it's work? And from an interview perspective, what would be the important terms that you may expect questions? When we say bonds, it's an agreement. Agreement between,
Issuer and investor.
yes, issuer and investor. And issuer assure that. So it means,
I
see,
cannot see. We are unable to see a screen now.
so you're not able to see my screen then. Investor. Bond, it means it's an agreement between issuer and investor. And that bond has a features like, and or I would say the piece of paper, this piece of paper which define face value, let's say 100, coupon payment, let's say 10% for per annum, maybe monthly, quarterly, annually, or at the time of maturity. That will be depends, because every bond type has a different features. So that depends. So the point here is all about, if you hold this paper as an investor, if you hold this paper, then you have a right. Right. And issuer has an obligation. Has an obligation. You have a right, and issuer has an obligation for what?
to pay interest.
Pay. To pay face value at the time of maturity and pay interest payment or coupon on a periodic basis. So maybe you would have a question, sir. What if issuer failed to pay the payment? What if issuer failed to make the payment? If this happened, then see here, issuer has an obligation. Investor, you have a right. Right for what? Right, you have a right to sell this piece of paper, carry the value 100 rupees value, right? And this 100 rupees value is backed by an asset. See this framework, this 100 rupees value backed by an asset. So it means you can sell. Asset can be equity shares, preference shares of a company, right? Apart from that, it can be building, technology, trademark, brand name. So all you can sell. All you can sell and take your money back. That's what you're holding the rights. You're holding the rights. Right? Any doubts so far?
No, sir.
Satish?
No, 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 no.
Okay.
Uh, one more. In bonds, I have raised, some people raise the question like, there is a put and call in bonds.
Yeah,
How
well,
we can
wait,
trade?
wait, wait, wait. This is like this
Yes.
basic. So we are going to discuss the types and all. So we are discussing bonds from the scratch. Just hold for a few minutes. I'll take you there. Okay. Another important question is how we create the bonds. Now we know what is bonds. Bonds, it means it's an agreement between issuer and the bondholder, which defines the terms which the bondholders receive periodic coupon payment, or at the maturity the issuer will pay the principal amount back to the that bondholder and all, right? And apart from that, it's bonds, it means in a definition where you can say bond, it means it's a fixed income instrument which carries fixed in which coupon or maybe interest payment on an investment. So that instrument we can call bonds. Or apart from that, you can define in such a way where bond, it means which represent the acknowledgement of a debt of a company. Bond, it means represent acknowledgement of company's debt. With seal or stamp of a company. That note or document can call bonds. Bonds has a multiple names: notes, tranche, agreement, and indenture.
The company debts with, what is this? SED? Or what is this
Yeah,
spell name?
companies debt also you can call, combinedly called. Right? So when someone asks what is bonds, you should highlight in such a way. What is bonds? What is bond? Bond represent the acknowledgement of company's debt with a seal or stamp of a company's that can be notes. That document, note or document can call bonds. Or in a simple way, previously we discussed about bonds, it means it's an agreement between issuer and investor, where investor has a right to receive coupon payment and principal amount at the time of maturity, and that document is backed by the asset of that particular company, and issuer has an obligation to pay the fair that the face value of a bonds as well as coupon payment on a periodic basis. Either way, one of the definition, it's not about definition but how you can define to the bonds. If someone asks you about what is bonds, so you should define in such a way. Most of the time you would face problems, right? So how can I explain to the bonds? Or someone asks about, hey, now tell me what is bonds, then you get tend to confuse where to start, how to start. Either one of the matter, you can pick it in your answer. Will you do that?
Yes, yes.
You can
Okay.
write it down if you want, or else it is a
Yes.
recorded session. After that, also you can prepare your notes about the bonds.
Okay, one more question. What if issuer fails to make the payment means, that one more I can repeat, right?
Which price?
If issuer fail to make the payment, what is the scenario?
issuer fail to make the payment, then it will default. Then that's what. So I just wanted to take one more example. If you see how you can create the bonds, or if I say you're looking for home loan,
Okay.
this is your home, the value of the house is, right, you're here and you are in a need of money.
Okay.
Then now you approach to the bank, which is Yes Bank. You came to the bank and you discuss about your problem, that you're looking for a 10,000 rupees.
Okay.
I'm manager at bank. Then I said, hey Satish, I cannot give you 10,000 rupees because you are not a salaried person. Then okay, you said okay. So if I want a loan, then what document that you're looking for? So on which I can collateralize my property or maybe any asset if I have, and then after you can provide loan to me. Then I said okay. Then if you have an agreement or a document of a property which can define that you are the owner. So the document you can submit to us. Let's say this one is the document, home agreement,
Okay.
name Satish, owner name.
Okay.
Then you said okay, so I have an agreement, right? So which I can give it to you. So it means this agreement you can submit it to the bank, and then
Get the
bank
money.
will pay 10,000 rupees to you, correct?
Correct.
If you observed entire matter in details, this property was the asset for whom? For you,
Satish. Yes.
on which you took a loan, because this property was belong to you. You took a
Yes.
loan on that property
Okay.
and you transfer the legal ownership right to the Yes Bank. Because after the loan, you will not be the legal owner of your property. Legal owner of the property would be Yes Bank.
Yes. Okay.
And now ask this question yourself. Let's say you promised to the bank that you will repay this principal plus monthly interest payment, and if you fail to make a payment, principal plus interest payment on a monthly basis, what will happen with you? Now you tell me. I give you the entire picture, property. Now you have transfer legal rights to the bank. So it means now you are not the legal owner of your property. You have original rights, but legal rights you don't have. So you cannot buy and sell that property without the consent or permission of Yes Bank, because you borrowed money from Yes Bank. So Yes Bank is the lender and Yes Bank is holding your property. So it means Yes Bank is holding your asset. So you have
Eventually,
collateralized your asset. So this document is your collateral or bank's collateral.
so eventually bank will sell the property.
Exactly. Are you getting me, Satish?
Yes, yes, got your point. Yes.
So if you fail to make the payment, and the same apply to the company as well, because company collateral their asset and submit it to the bond holder with the signature of a company and all, with the promise of that if company fail to make a principal and interest payment on timely manner, then bond holders can sell the company's assets. So it means bank, in this case, yes, bank can sell this home to XYZ. The similar way, company's office bondholder can sell the company's office to someone else and recover their money back.
Got it.
Bondholders can sell the company's office, just replace the home and consider this as the company office. Now you can link entire picture with the bond part.
Yes.
There is no change in it. Just instead home you can say it as a company's office.
Okay.
So company surrender or collateralize their company's office to the bond holder. If company fail to make a principal or interest payment on timely manner, then bond holders can sell the company's office to someone else and recover their money back.
Okay.
That's what bond it means. And if you see the definition, represent the acknowledgement of a company's debt with seal. Seal it means with represent that company took a loan from that XYZ bond holder. It's like a loan. But the point here is, let's say, here in this case, the property value is around 10,000. But in a company case, let's say company office value is company office. Value is 10,000. So this 10,000 you can split it, let's say, into 5. So here you can say bond 1, bond 2, bond 3, bond 4, bond 5. And each portion you can represent with the value like 2000, the face value of a bond. And you can sell it this portion to the investors. Investors can be this, you can sell it to the hedge fund, this you can sell it to the mutual fund, this you can sell it to the PE, this you can sell it to the HNI, and this portion you can sell it to the retail investor. And along with that you can promise coupon payment, so that you can offer 5% coupon payment on a monthly basis or maybe yearly basis. This is all about bonds. This is how bonds work. At the time of maturity, you can repay this 2,500 plus the end portion of interest payment to whom? To the bond holder, and take your asset back. Otherwise, you don't have a rights, means company don't have a rights on this asset. Company collateralize this value. Any doubt? Are you with me?
Yes, yes, yes.
Now if I
What is it?
ask this question, what is bonds? Can someone try? What is bonds?
Yes, yeah,
Hmm?
the acknowledgement of company debt with a seal and stamp of the companies.
Hmm.
That note or document can call bonds. Bonds can be called like notes, transi, agreement.
Yes. And how it's work? You can give it this simple
Yeah.
example. Let's say company office has a value of rupees 10,000 rupees. So that 10,000 rupees you can split it into different tranches or notes or bonds,
Yes.
and you can issue
Okay.
to the interested people. So who can be hedge fund, mutual fund, private equity, HNI or retail investors. So they can buy it. So which you can offer the interest payment to them. See, this issuance process has different methods also. Same example, let's say a bond. Face value of a bonds and issue price of a bonds. In case of A instrument, if you see, face value is around 2500, correct?
Yes.
Face value, because it was original split. 10,000 divided by 5 if you do, it was original price of a bond was around 2500. So this price, if you issue it means sell. Sell it means to raise capital, to sell the asset and to raise capital. To raise capital. To issue these bonds in the market at the same price. Issue price is also same price. This situation we call par. Value at par. There is no change in face value of a bonds and issue price of a bonds. There is no change in face value of a bonds and issue price of a bonds. Are you getting me?
Yes. Okay.
Satish? Swarup?
Yes. Yes. Yes.
Swarup, are you with me?
Yes.
Swarup?
Yes, sir.
Okay.
Yes, sir.
Respond to it. Let's say in case of B bonds, the issue price is which is something issue price is again same, but sorry, the face value, but the issue price is, let's say this one. If you see, the face value of a bond is 2500 and the market price or issue price which is something around 2800. If you see the 300 rupees extra which company gonna receive from the bond holder, so it means bond holder pay the 2800 to purchase this 2500 bonds. So where the bond holders will pay the 300 rupees extra to you. So this situation we call premium. Where company will receive 300 rupees extra as a premium.
Okay.
But the point here is this really happened in this industry? Sometime if the TCS issues bonds, then TCS bonds, you may see the TCS can issue the bonds on premium because TCS is in a sound position now. If you compare with any other firm, let's say S Bank now is under debt, so they cannot issue the bonds on premium and nobody can purchase it even. So why will you purchase, or why will you pay the 300 extra? Because see, issue price will be this, but the maturity price or redemption value will be this only. In case of this as well, redemption value. Bond will be redeemed at only this price, not this price. Under any circumstances, bonds will be redeemed at face value only, or face,
Okay.
not issue price. So it means here in this case, this would be your loss, correct?
Yes.
300 as an investor, if you pay to the company, you're going to receive only 2500. So 300 would be your loss. So why will you do that? In case of if the company is in a sound position and if the company will offer attractive interest payment or high interest payment. High interest payment than the market. See all the points which you may expect questions on, like why company will issue the bonds on premium. Every statement, every point is essential, every point is important. What is the difference between face value of a bond and issue price of a bonds? That's how you can define this pricing structure. How the bonds works, you can take the example of this and you can define the term. Right? Every term is essential. Every term. You can give the example of this. How the bonds companies create and issue the bonds and raise the capital. What is bonds? You can define in this way. Assets can be bonds. You can define in this way as well. All the terms are very, very, very important. You cannot find all this on Google in this way, in a simply manner. You would see the simple 2-line definition and done. I'm putting my efforts. It's your job also to write it down in a notebook in your way, or the way you understand this matter, and to explain it in the interview. Create the question like what is the difference between face value and issue face value of a bonds and issue price of a bonds. Then write down these examples, how it is work. The same goes with the bonds as well. What is bonds? Then write down the matter below. And how it's work, write down this. Then after the session, then you would ask questions. So on which area we expect the question? See, all the areas are important. I'm covering only important areas where you would expect question. Right? Then the third way would be, let's say C bond, the face value of a bond is again 2500, but the bond issued in the market, issue price is 2000 only. See, company's asset value is 2500 because this is your asset value, pure asset value, face value it means. But the investors, they are not ready to pay you 2500. Why? Maybe your bonds are risky, or this value is risky, correct? You are raising capital through bond, it means you are in risk eventually. That's the signal. You are issuing capital through bond, it means you are in risk. When you take a personal loan, right, then it means you don't have own fund. That's what you're taking personal loan. You're taking home loans, so it means you don't have a cash in your bank account. That's what you're taking loans. Am I right?
Yes, sir.
So it means eventually you are in a risk. And if you see the risk, then investor, they will not pay you the total value. They will buy the bonds. Issue price, it means buy price. Investors will buy the bonds at 2000. So this situation would be discounted bonds. And that's what there is a type of a bonds which is zero discounted bonds, or zero coupon bonds, or discounted bonds. At the time of At the time of buy, you need to pay only 2000, but at the time of maturity, redemption value would be this. So you will receive extra 500 rupees. Investor will receive extra 500 rupees. Redemption value. In a system as well, you would see many times. If the bond is discounted, then you would see the asset class which is distressed assets. Distressed assets. Distressed assets.
So what is mean by distressed assets?
Risky. Why you're
Okay.
getting discount? Because the asset is risky.
Okay, sir.
There is a risk. And that's the reason. See, if there is no risk, so you are paying extra 300 rupees to buy the 2500 bond. And if there is a risk, if I sell dented phone to you, so will you buy the, let's say I have purchased iPhone at rupees 90,000, and now it is like that phone has been dented or scratch over there. So will you pay me the 90,000?
No, sir.
Why?
Because the phone is damaged.
Phone is damaged and there is a risk. It can be
Yes.
happen anything to the device in near term. Correct? And if you sell that phone, then you will not expect that value. So might be that value will be drop it down. Are you getting me? So those assets, if I take the example of Sri Lanka, if the Sri Lankan government issued bonds and if the US government issued bonds, you would see the difference because Sri Lankan bonds would be risky bonds and US government is the developed country, right? You would see the bond because Sri Lanka government will have to issue the bonds on discount. And here you may expect par or premium. Why? Because of risk. Because of risk.
Yes.
Yes Bank. Take the example of Yes Bank. Face value of a bond is, let's say 100 of Yes Bank. So will you buy the bonds at this face value? If you are a true investor, then you will check it what is the situation of Yes Bank and then after you will price it. And I'm sure the price which will be around at 80 rupees only. Because Yes Bank is a debt ridden company, they have a debt, high debt. But now they have a good news, which is Yes Bank sold their entire debt or loans to the different institution. That is Carley Private Equity Fund. They purchased the entire loans of Yes Bank, and Yes Bank received 8,000 rupees fresh liquidity, and now they are doing the business in this way. Hope so. You're enjoying this session. Are you enjoying
Yes.
this?
Yes, sir. Now it is crystal clear.
Now we'll move towards the types of a bonds. Types of a bonds. First type would be convertible. Convertible.
Hello? Yes? Hello?
Convertible bonds.
Actually, he's in session.
So if you see convertible bonds,
Yeah, I'll tell him.
so companies issues bonds which the bonds can be converted into preference at the time of maturity at the time of maturity bondholder can hold the right, bondholder can hold the right for what? To convert the bonds into preference equity or either common equity. See this. Convertible bonds, it means at the time of maturity, bondholders can hold the rights to convert the bonds into preference equity or either common stock. That feature you can exercise when you purchase the convertible bonds. Any doubt in it?
No, sir.
And how this conversion will happen? Let's say you had invested these bonds in 10 years ago. The face value was 100. You had invested in Yes Bank. And today is the maturity of a bonds. So now company is going to pay you, which is 100. Along with that, 14 rupees as a interest payment. So total 140 rupees that it will receive to you. But you want interest payment in cash. So that interest payment will process to you, and you're looking for 100 rupees as conversion into the, let's say 50 rupees into preference equity if company has that facility, and 50 rupees into common equity. How this will happen exactly? 100 rupees as a bond value, common equity market share price. You can check it on Google as well. The Yes Bank current market share price, which is around 15 or 16 point something, 16 rupees something, right? Check it if you want. Preference shares current market price of Yes Bank is around, let's say, 50 rupees for per shares. Are you with me?
Yes, yes.
Yes, sir.
So here now you can convert 100 rupees, you can convert it, conversion process. Now you know the value, right? If you know the value, then it would be very easy to convert. 50% want common equity shares and 50% want preference equity shares. Then you can convert that 50. So it means you can credit one preference shares and you can credit. So here would be required little bit, 50 divided by 16, calculate, and now let me know. So it goes around 62 to 3 3 shares which you can credit to the investor, right? 3 shares. And what about fraction, which is 2 rupees? So which you can process in cash again, because 16 into 3, 48 rupees, correct? 48. So 3 shares which you can transfer to the investors against 50 rupees of a bond. Sorry, that the 50 rupees of a bonds, because bond entire value was 100, but with the value of rupees 50, investor want 3 shares of common equity and 1 shares of preference shares, because here 1 shares is equal to 50. That's what 1 shares will receive, and here 1 shares is equal to 60. So 3 shares will receive. This is how your conversion process will work. And here we actually create conversion corporate action. From a processing point of view, corporate action team, they create conversion corporate actions to create this type of event and process it to the investors.
What is the 2 rupees? It's a coupon, it's a cash, right? It's a coupon.
Sorry?
2 rupees. The 2 rupees example, you got it right.
So 2 rupees will return to the investor. So you cannot buy the shares in fraction. Simple. You cannot buy the shares in fraction. Sometime you would expect question. You cannot buy the shares in 2 rupees. So there is no process we have. So simply return this to the investor back. Any question? I'm done with conversion part. Now it's your turn. If you have any question, you can raise. Swaroop,
No.
see, Swaroop, we will have an interview, mock interview, okay? So I'll ask a lot question on this part. If you have any question, you can
No,
raise it now. You're getting all the points, right?
yes, sir. Absolutely.
Okay. Then after conversion, then I would say redeemable. Redeemable. So bond holders hold the right or rights to redeem bonds at maturity. So it can be fully redemption, or it can be
Right.
partial redemption. Here you would see the two types in redemption. Let's say total value, face value of a bond is 100. Again, at the time of redemption, you want just 50 rupees in cash. Redemption will be in cash. Redemption will be in cash. right? Redemption will be in cash. At the time of redemption, you want 50 rupees in cash and rest 50 rupees you want in stock. Or maybe sometime. So let's say the original maturity is 10 year, but after 5 years you are holding the rights. So that we'll discuss about, with regards to the same example redemption, we'll discuss about that putable bonds. So which we can call bond swaption even, but that is something different, bond swaptions. So you will have a right to swap the interest payment of a bonds. So we'll discuss about this portion. There's two terms we'll discuss about, but this we'll discuss in next session. This we'll discuss now. Putable bonds. Putable, it means holder of a bond, holder or investor, you can say holder of a bond, hold the right to sell the bonds. Hold the rights to sell the bonds company before the maturity. And how this work? Let's say original maturity is 10 years. You have invested value here. You will receive this value here originally, right? This is 0. But this is like putable bond. Putable bond, 5-year duration. So this type of putable types of bonds will offer the right to the bond holder, to sell the bonds to the company up to 5 years. So they don't need to wait. So it means this patch, the bond holders can sell the bonds any point in time. Maybe after 5 years, maybe at 5 years, 7 years, 8 years, 9. Here also bond holders can sell it. That depends on the bond holders, because bond holder is holding the right to sell the bonds, but a minimum criteria is minimum requirement is you should hold the bonds at least for 5 years, and then after you can sell it. But the main original duration of a bond is 10 years. You don't need to wait for 10 years to get your money back. After 5 years, you can sell the bonds at any point in time. That option we called putable option of a bond. And here you would see, let's say face value of a bond is 100. So investor can only sell 50%. So it means 50 rupees. So this portion also you can link with the redemption, that is partial redemption. And if the bond will redeem it fully, let's say investor want 100 rupees, then this would be your 100% redemption. This is fully redemption. Are you getting me, guys?
Yes.
Any
Yes, sir.
doubt now?
No, sir.
Then what about callable bonds? Callable, it means company hold the right For what? To buy the bonds back. To buy the bonds back from the investor at predefined price. Predefined price and conditions. Callable bonds, it means company hold the rights to buy the bonds back from the investors at predefined price and conditions. How this will work? Same, the duration of the bond is, let's say, 10 years, and minimum duration which is required, which is 5 years. And here the company will, this is for like company will decide. Company received 100 rupees. Company will pay, main amount will be paid on or after 10 years. You can write it down this diagram as well if you want. And now here the after this call option will be exercised. Call option, because company is holding call option where company has a right to buy bonds. But when company can initiate this action, at least company should wait for minimum 5 years duration, and then after company can call the bonds any point in time after the 5 years, maybe after 6 years, 7 years, 8 or 9, depends. Question would be why, see, interview question would be why company will call the bonds. I'll answer to this question. If interest rates in the market goes down significantly, then company can call the bonds back. With an example, let's say previous bond face value is 100 and interest rate was 10%. But now company has an input, or company done some research and now they got to know this 10% can be dropped in the market and it can be up to 7%. So here if you see, if company pays interest payment to you, the value would be 10, and here let's say if companies pay the interest payment at rupees at percentage 7, then the interest payment on 100 would be 7 for per annum. So where company can save the 3 rupees on bonds, eventually company can save their cash or reduce the interest payment liability. But the point here is this simple process? No. To convert, to call the bonds back and again to reissue the bonds. So that process takes time, right? Then company will have to borrow money from the market even to fulfill their needs and all, to repay their entire value. Let's say, see, company, they don't have this 100 rupees in their pocket to repay the bond holders, right? So company will borrow this money from XYZ bank for a time being, maybe for a 1 month, 2 months, 3 months, right? So that amount also will take some cost, and restructure process also takes some cost to delist the old bonds, to reissue the new bonds. So this process takes time. So company, it's part of capital restructure process or debt restructure process. Debt restructure process. It's like an advanced level of decision making, capital budgeting or decision making process. You don't need to be a part of that, but at least you should know theoretically. So that process takes cost. So company will evaluate the cost, and then after company will take the decision whether company will call the bonds back from the investor or not. There is only significant change, then company will not call the bonds back from the market. And if there is a change which actually, let's say here company is now able to save the cost which is 3 rupees for per bonds, right? And up the restructuring is taking cost around 1 rupees. So it means still in that case company can take the decision and initiate this restructure action, where company can save the 2 rupees for per bonds. Okay. And why sir will investor will sell the bonds in the putable option? Then why investor will do this? You should have a question, and you may expect question like this in an interview process. Why investor will exercise the putable rights? Investor will exercise the rights if the bond prices goes up, interest prices goes up. Why? Same example under putable. Let's say face value which is 100 and current interest payment which is 10. See, bond holders think in a different way even. I'll tell you that also. If this 10% interest payment goes down, right? If this 10% interest goes down, let's say 7, then you don't need to worry about anything. As a bond holder, you don't need to worry about anything because you have a right to sell the bonds. Right to sell the bonds at 10%. If the interest rate goes or drop down in the market, so you don't need to worry about anything. But what if this interest, current market interest increase, and that is, let's say, up to 12%. In that case, you cannot sell the bonds at 12. Or in short, you cannot exercise the benefit of this 12% interest payment. Why? Because you have an obligation. Max to max, you can sell the bonds at 10% only. See, investors are also very smart, like hedge fund managers and private equity investors. And what they do, they sell the bonds at, after 5 years, they wait till the maturity. Maturity, it means that the minimum requirement period, right? And after 5 years, or maybe at 5 years, they sell it. They sell it and buy the bonds. Let's say this was a TCS bond, and this is like new bond who is offering 12%, let's say, which is Wipro bonds. So it means you can sell the TCS and you can buy the Wipro at rupees 12% for per annum. So where you would see the 2 rupees difference in the value. So that would be your profit. So you can enjoy that benefit. And that's what investor also take the decision on time to time. You should demonstrate your answer in this way, and then see, nobody can reject to you. In-depth understanding about the product. Okay. So rest parts will cover in maybe tomorrow. We'll connect and we'll cover the bond part. We required one more session to cover the different terms of a bonds, amortization, accretion. There are a number of things. Then different types, zero discounted bonds, then perpetual bonds. There are other types as well. So I'll send you the material for the same. So meanwhile, you just go through it, different bonds and all.
Okay.
So that will help
Okay.
us
Uh,
to. Hmm?
Thank you.
sir, will